Now, my very good students, whenever you hear about financing decisions, what do you think about whenever financing decisions are being mentioned to you? Yeah, financing decisions. We are looking at how do we raise capital, isn't it? So all financing decisions is about capital raising, which will be equal to cost of who? Cost of capital. Because when you raise this capital, you must pay something in excess. So financing decisions basically is our cost of what year? Capital. I'm so sure you guys have heard about these financing decisions. How do we get to raise our capital? Do you remember the sources of capital? Types of capital or source of capital. Number one, equity. Number two, debt or debentures. Number three, preference shares. Yes, preference shares. But first, we start by mentioning their cost of capital. Give me a title, cost of capital. We look at the definition. So tell us the cost of capital will be COC, I mean, COC. Tell us there that the cost of capital is the minimum. Cost of capital is the minimum rate of return. Rate of return that a company must earn. That a company must earn on its dividends. Must earn on its investments, on its investments. Look at me now. On its investments. On its investments. On its investments to satisfy its providers of finance. To satisfy its providers of finance. So cost of capital is the minimum rate of return that a company must earn on what year somebody? Its investments to satisfy its providers of finance. Debt holders have given us this money to invest. Yeah. Equity holders have given us some amount of money to invest. Whenever we invest this money, we need to get that minimum return for us not to make a loss. For us not to make a loss. Give us a title there, sources of finance. Sources of finance. You know them. You've already mentioned them to me. So we have in this case here, number one, equity. Number two, debt. Number three, we have preference share capital. Preference share capital. So we have equity, debt, and the preference share capital. Equity is divided into two. Do you know what and what? Retained earnings, ordinary share capital. So we have retained earnings versus ordinary share capital like that. All right. Yeah, the owner's funds. Owner's funds is what we refer to as what here? Equity. All right. So then we start looking at each one of these, and I would want us to start with the cost of retained earnings. Mentioned there, cost of retained earnings. Cost of retained earnings. So this is the return. This is the return required by shareholders. Required by shareholders. Required by shareholders on profits. On profits retained in the business. So when a company retains profits in the business, this money, of course, the owners would have wanted to use this money outside there. So when we leave this money at RCM, we as the investors would expect some return. We call that return cost of retained earnings. So then what is the formula that we shall use here? Formula. So the formula, we use what we call the dividend valuation model. Dividend valuation model, like that. Yeah, very, very important, the formula. That the cost of retained earnings, KR, K stands for cost of retained earnings will be equal to DO, which of course has to grow. Dividends will always grow. Dividends model, DO into 1 plus G all over PO. And then, of course, at the end of the day, we must add what we call G there. We must add what we call G there. But D, O into 1 plus G equals what here, somebody? D1. And therefore, you can very easily get your KR being D1 over PO plus G. So please don't forget that D1 stands for expected dividends. Expected dividends. Future dividends. O means today, current dividends. All right. DO, because of O, these are current dividends. Current dividends. How about G? Growth rates. How about PO? Current price, isn't it? Or current market price. Current market price per share. Current market price per share. And then, of course, not forgetting that KR is cost of what here, somebody? Cost of retained earnings. Cost of retained earnings. So when you start doing our past paper question, you'll be able to appreciate exactly what we are talking about there. Then now we have cost of what here? New shares. Cost of new shares, mentioned there, cost of new shares. KS or KE, doesn't matter. KS. So our KS, ladies and gentlemen, will be equal to DO into 1 plus G all over, in this case here, what we call PO minus what here, somebody? Flotation years. You can get some students doing it very, very well like this, but they forget our what here, somebody? Our G. G must be added at the very end there. Yeah. So in this case here, F will be flotation cost. Because you see, shares unlike retained earnings, shares, you must make some efforts to raise money through shares. You must sell them, you must advertise them, you must get an underwriter. All right. So at times, in this case here, you will get some questions saying KS equals D1 all over NP plus G. I know you know what D1 is. How about NP? Net price. Net price, which is the price you're going to fetch minus any flotation cost, minus any discounting they are there. Net price. What amount are we getting in the organization? Or net proceeds. Or round. So then, with your permission, I'll be able to go to the next item, which is the cost of preference shares. Cost of preference shares. Yes. When we talk of net proceeds, any cost they tell you, you're going to indicate, you must always subtract, including that discount. All right. So in this case here, cost of preference shares will be our KP. So this one will be the annual preference dividends. Annual preference dividend expressed as a percentage, of the net price or net proceeds, i.e. KP equals preference dividends all over net proceeds. Of course, times 100. And then the question would be, how do we get preference dividends? How do we get preference dividends? We take, in this case here, the dividend rate. Dividend rate times par value. Dividend rate times par value. Dividend rate times par value. Please, this question, I would want to go very slow on it, very slow, because I know this some of those areas that must be tested. Must be tested, will be tested. We go to cost of irredeemable debt. Cost of irredeemable debt. Cost of irredeemable debt. Cost of irredeemable. So we have there cost of irredeemable. When it's irredeemable, it means permanent. Yeah, there is nothing like returning money. So cost of irredeemable debt. Yeah. So for irredeemable debt, this KD will be equal to the after-tax cost of permanent debt. After tax, cost of permanent debt. The after tax cost of permanent debt formula, KD, will be equal to the interest. Interest into 1 minus T. We divide by the net proceeds. What are we going to receive out of these bonds? Well, the net proceeds will be the bond amount minus any flotation, minus any discount, any expenditure given. Of course, whatever we shall get here times what here somebody times 100. If bonds are issued at par, if bonds are issued at par, yeah, with no flotation cost, with no flotation cost, our KD will be equal to interest rate into 1 minus tax rate. So we are told that this bond is issued at par, yeah, and there are no flotation what here cost. Then our KD will be equal to interest rate into 1 minus what here somebody? 1 minus tax rate. And remember, the same formula will be applied in bank loans. Apply the same whenever we have bank loans. You know, we have got two types of loans. We have those loans we can go walk to the bank and get a loan, or we issue bonds in the secondary market. So for bank loans, we shall be using this formula. Very, very important. Then we go to cost of redeemable debts. Cost of redeemable debts. Cost of redeemable debt. Cost of redeemable debt. So first of all, what is redeemable debts? The debt which can be converted into, or we do what here? We refund the money, isn't it? Or we refund the money. All right. Is there somebody who is able to remember this formula from what you did in financial management? Yes, Stanley. Able to remember that formula? Redeemable debts. Let me hear from my students here. Cost of redeemable. So remember, this is a refundable debt. Eh? This is a refundable. A refundable what here? Refundable debt. Nakumbuka? Okay, yield to maturity the same years. So then our KD here will be equal to, you take the interest given into 1 minus tax. It's called an approximation formula. Interest into 1 minus tax plus redemption value minus NP. So this is to be divided by N, average. And then everything here, everything to be divided by RB plus NP all over 2. All over 2. It's an approximation formula. It is an approximation formula where And your examiner nowadays loves this formula where KD is the after-tax cost of redeemable debt. After-tax cost of redeemable debt. Then we have, in this case here, I is the annual interest in Kenyan shillings. In Kenyan shillings. All right. Then we have our T, which is the corporation rate. Corporation tax rate. Corporation tax rate. We have our RB, which is the redemption value. Redemption value. Redemption value or maturity value. Then we have our NP being net proceeds. Net proceeds from issue. Net proceeds from issue. All right. And then we have N, number of years to redemption. N stands for number of years to redemption. Now, remember initially the way we used to do this KD, we used to bring this one minus T here initially. But now people are saying, you know, this is what we call capital gain. The capital gains are not tax allowable. It's only interest, which is what here, tax allowable. So things are changing, you must change. I think, but again, even if in an exam you have to use 1 minus T there, nobody can ever give you a wrong. All right. Now, my very good student, we can now straight away, just a minute. So, and then, of course, after getting all these, we shall be able to get what we call W what here, somebody? ACC. Is there somebody who is able to remember? First of all, this weighted. Yeah, weighted average cost of capital. How do we get this WACC? It's very easy. Weight of equity, cost of equity, plus weight of preference, cost of preference, plus what here, somebody weight of debt, cost of debt, into 1 minus what here, somebody? Yeah. So remember, cost of equity, no tax allowable. Cost of preference shares, no tax allowable. It's only KD which is tax allowable. KD, where we make the tax adjustment. All right. That is weighted average cost of capital. That's how we get it. All right. Very, very important for us to be able to really appreciate it. All right. Then we have what we call weighted marginal cost of capital. Weighted marginal cost of capital. Cost of capital. WMCC. All right. So this is the cost of raising. Cost of raising new capital. Cost of raising new capital after considering financing breakpoints. After considering financing breakpoints. points. Full stop. The question here. A very good question there. So, of course, in some questions there, you will get a situation where you will be given KDs, which are what you're pre-tax. So in that case here, you'll have to do the tax adjustment. But for sure, if you had adjusted tax up there, then this 1 year, you will only be required to know that always shall be KD after what year? After, if you have done it after the adjustment, you don't do it again here. That's a very, very good question. So after considering the financing breakpoints. So the formula, how do we get WMCC? We take sum of the weights times the marginal costs. So weights times marginal cost, like that. Summation. So in this very question we are doing here, it has got that concept. Then they are bringing in the last thing we're discussing there before we look at that first question is this word breakpoint. So mention there for us breakpoint. So breakpoint. This is the level of financing, where one source of capital is exhausted. Where one source of capital is exhausted. And a more expensive source must be used. So the level of financing where one source, which normally is cheaper, where one source of capital is exhausted and a more expensive source must be done what here, somebody must be used, is what we call breakpoint. Yeah, we are finishing up this cheaper source of funds, and then we go to the next source of fund, which will be expensive. So we break. Very, very important. So then let's look at our past paper question, which I hope they have. The past paper question that we are doing, ladies and gentlemen, is this one. The past paper question that we are doing, do they have it? Do they have it? September 2021, question number 4B. September 2021, question number 4B. Question number 4B. Question number 4B. The online students, have they gotten this question? The online students, have they gotten this question? The online students, by any chance? Marikov, great. So we shall move on it very, very slowly. And then we go to something different. Or so then here we, Dinosoft, yes. Dinosoft. All right. So the very best thing is for me to do what here. Send myself this question here so that I can project it here. That is the right thing to do. When I project it, it becomes much better. Because there must be a ninja somewhere who does not have paper. September 2021. Up here to the email I sent. Wait. Great. Nope. All right. I don't know why it's bringing this one. Anyway, let's just go straight away. Then I should be able to read it here. We shall overcome. All right. So we are told in this question, we are given Dinosoft. So Dinosoft Limited's capital structure, which it considers optimal, is given as follows. We can see debenture that is there. Reserves, ordinary share capital, preference share capital. The firm's historical earnings per share and the dividend per share has been given there. Number two, the company's ordinary shares currently are selling at 50, blah, blah, blah. Number three, very good. So they want us, number one, to calculate the break point in the marginal cost of capital schedule. Break points. So what are we supposed to do in this kind of what year a question? So these are very, very easy questions. I will end up getting all the marks in here. All of them. All of them. So first of all, I will write the formula. I will come here and write the formula. I know that break point, we start with the first one, which is break point of what year? Equity. Because we go to each source one at a time. So break point of equity, what are we supposed to do? To get the break point of equity, you give us the maximum amount available. Maximum amount available all over weight of equity. Maximum amount which is available from that source all over the weight of equity. So we start with the weights, my students here. Let's mention their weights first of all from the question given them. Are you able to see the weights over here? Are they able to see the weights of the question? Yes or no? I suppose yes. So the weights provided there that I'm able to see so vividly, what you needed to do was to consolidate retained equity and reserves, in reserves. Call them equity. Give them one name. 60%, Ah, wow, great. Great. So what do we have there? So our question, our table, the first table given there, to enable us get the weights, we must look at the capital structure. So if you look at the capital structure proportions. So we have debentures. So debenture, how much? 25. We have equity. So equity, I will take the reserves belong to the owners of the business. So 15 plus what here, somebody ordinary share capital, which is 45, giving me 60. That's equity. And then we have preference share capital over how much here, somebody? 15. All right. So remember, these are Kenya shillings millions, which gives me what here, somebody? So the percentages, which of course now will be the weight. So this will be 25 over 100. Of course, times 100. So this will be 60 all over the total 100 times 100. This will be 15 all over 100 times 100. So the first one is 25%. It's a coincidence that this was the 100. Would have been something different. So 50%. Remember, all the weights must add up to what here, somebody 100% or just one, isn't it? Yeah. So we have taken care of this. We know that the weight of equity is 60%. We have taken care of the weight of equity. What I'll be calling WE is 60%, which is the same as 0. What here, somebody? 6 like that. So remember, under equity, we have got two sources. Which source is cheaper? Retained earnings. You see, under equity, you have retained earnings and we have ordinary there. So to get the break point, even if the examiner was to be silent, under equity, we must always start by getting the break point of retained earnings. So under equity, start by determining weight of retained earnings. You see, this examiner was quite nice because in the requirement, he told us he told us to calculate the break point in the marginal. Actually, he never told us. It's us to know. Calculate the break point in the marginal cost of capital schedule. So, and we have started with a weight of equity. Now we are getting break point of equity. And the break point of equity, the first one will be break point of what here, somebody? Retained earnings. So then the question will be, do we know how much is retained earnings? How much is the retained earnings really? I will give you 1 minute. You give me an answer. How much is the retained earnings? I'll give you 1 minute. Use note number 3. Use note number 3, where they have given us a constant payout ratio of 40%. That's dividend will be paid. So we are paying 40% as dividend. Retained earnings will be what percentage? 60. And then you can see they are declaring a net income of how much? 40 million, isn't it? We am alone, but I will overcome. I am alone, but I will overcome. Almost overcome. So remember here, since the company pays what here? Since payout ratio is 40%, then retention ratio will be what percentage? 60%. And then we have expected earnings. So expected earnings here, 40 million. The net income, the profit after tax, and therefore retained earnings will be the 40 million times the percentage you expect to retain, isn't it? Times 60%. We gave you guys what figure? 24 million, isn't it? 24 million. All right. So then come here, and they give me breakpoint of retained earnings. Breakpoint of retained earnings. So remember, I gave you the formula. It is about what your maximum available amount is. In the form of retained earnings, isn't it? Divided by weight of equity. Divided by weight of equity. Divided by weight of equity. So the maximum available amount, because it's retained earnings, we know we can get 24 what here, somebody? 24 million, isn't it? All over weight of equity, we already have weight of equity. You guys gave me 60%. So 24 million divided by 60%, that gave you what figure? Mm-hmm. 40 million, eh? 40 million. $40 million. So just for the sake of us understanding something here, the interpretation here, just a small interpretation there, is that up to Kenya shillings 40 million financing, Kenya shillings 40 million financing, the company will use retained earnings. That is the break. We shall stop 40 million. Shall use 40 million retained earnings. Beyond the 40 million, what will happen? It will now go to shares, isn't it? It must issue new shares. It must issue new shares. So we are breaking at 40. Breaking at 40. Nobody will be asking you to do these interpretations now. I'm just trying to explain it so that as we get to doing the question, you'll be able to see what we are talking about. So under equity, we have two sources. We have retained earnings, and then we have what your ordinary shares. So go ahead and give me the breakpoint, ordinary share capital. So go to the question and see whether there is any information telling us the maximum amount that we can get from ordinary share capital. Let's read this together. Let's read this together. Let's go to ordinary share capital. Look at note number 4. The company can raise additional capital as follows to finance accepted investment projects. Equity capital. Utilize all available retained earnings for the year ending 31st December 2020. All. Any extra external equity will be raised through issue of new ordinary shares at a flotation cost of how much? 10%. But have they told us like how much can we get maximum from these ordinary shares? So in this case here, there is no maximum that is given. So no maximum amount given. And therefore, there is no breakpoint. You get a mark by mentioning that. No maximum amount. You see, for earnings, we had a maximum amount, 24 million. Here, there is no maximum amount. So no breakpoint. From there, then, gentlemen, I would want us to go, we have three sources of capital. We have equity, we have debt. So let's go and calculate breakpoint of debt. So let's get breakpoint of debt. I love this because this will come. How do we get this breakpoint of debt? No, I should have just mentioned there, breakpoint like this. It's very easy. You simply take maximum amount available, yeah, from debt, isn't it? We divide by weight of who? We divide by weight of debt, like that. So there must be maximum amount available. Maximum amount available. Of which I would want you to try doing. I would want you to go to note number 4. You try doing this. You must do it. Try doing this. Try doing this. You must do this. Everybody must try this. From note number 4, breakpoint of debt. Fortunately, I normally teach very, very good students who are really trying their best to understand this. Which reminds me of some movie we saw long time ago of No Retreat, No Surrender. Ever watch that movie? Problem with accountants, they don't like movies. Hata ukiwauliza kama ishaenda kuona movie ya 3D, unajawahi hiyo. Mimi nimeenda mpaka ya 70, ile kuna effects. Kama kuna nyota wananyeshewa. Kama kuna nyoka zinapita, najua mali. Kama kuna nyoka zinapita kwa movie, hapo wameweka manyoka vitu kama manyoka chini. So watu accountants peleka wengine, walipiga nduru. Walipiga nduru sana. So utapata kuna accountant saizi hata hajaona polygamist. Nyinyi mmeona polygamist? Sure. Mnajua Jonas? So unaona wewe, it's only one out of online. You see, I'm busy, but I mean, I like movies. I watch movies. I watch them because I want exposure in it. Online kuna mwenye ameona Jonas kweli? Wacha nione online kama kuna mwenye ameona Jonas. Hata Jonas C. Jonas C. Online kuna mwenye ameona Jonas kweli? Or the trade peke yake? No, you need to watch the whole thing. There is even a book, a novel, isn't it? Yeah. Inshallah Bakar. But of course, I know right now your eyes are fixated on passing these exams. Yeah. Unajua malebo peke yake? Hiyo imeisha hata fashion sasa. Hiyo mimi najua sana. Mimi najua sana. Tuna watch sangapi? Create time. This is you create time. Through movies, you can really get a lot of exposure. Lots of exposure. 100 billion. Oh, answer here. Where? How much are we getting there? He's getting 100 billion. Thanks for trying. Thanks for trying. Most anasema no maximum given, no breakpoint, no retreat, no surrender. Brothers, you have 100 billion. Because ukienda kwa note number 4, hebu angalia note number 4. Note number 4, debentures. See, that is debentures. New debentures can be sold. Very good. At a coupon rate of 13%. The debentures will be issued at what year? At par. But they're not telling us how much. What is the maximum amount you can receive from debentures? It's like it's unlimited. And if it's unlimited, then there is no breakpoint, isn't it? No breakpoint. That's a mark you are getting. That's a mark you are getting very fast. So in this case here, no maximum amount. So no breakpoint. Now we go to the breakpoint of preference share. This one has breakpoint of preference shares. So Stanley, we've got a time naangalia movie. It's very, very important because you guys are global citizens, eh? You're global citizens. Ukipata umetoka hapo unafanya kazi Dubai. Sababu hujaona movie yoyote, unabeba miniskirt kwenda Dubai. So utavaa wapi? Utavaa wapi? Utapigwa mawe. So unafaa kujua hivi vitu hizi. Unajua. So again, for preference shares, I don't think they have given us a maximum, isn't it? No maximum here. You got that right. So no maximum. And therefore, no what here, somebody? Breakpoint. But if the maximum was given for preference share capital, I would have taken maximum amount available if it was given, isn't it? Preference share capital, we divide by weight of what here? Weight of preference. So here nothing really, that is it. That we, yeah. So calculate the breakpoint in the marginal cost of what here? Capital schedule. That is what we are required to do with regard to those three sources. Kienda kwa swali lingine tunaona hata ni mingi tutatangaza. Ilikuwa na moja tu peke yake. Now, number 2, they want us now to give them the marginal cost of. There is no way you'll be able to get that marginal cost of capital until you get the cost of capital components. Cost of capital components, the K. So we start with the cost of retained earnings. Start with cost of retained earnings. Then we combine them with the weight, isn't it? So start with the cost of retained earnings. Hii formula mimi siwezi kushindwa hata siku moja, sababu kuna jamaa moja mimi napenda sana kwa siasa hii siasa. Mimi napenda Gachagua hivi. Mimi napenda viongozi wote. Yeah. Because kama serikali ikiwa in opposition, what will happen in Kenya? Sitakuwa international disaster. Mimi naona watu wakieta ama wewe penda, unaona mbona wanakuwa wakali katika opposition. Hao ndio mimi napenda sana mimi. Kama Gachagua ni thorn in the flesh, isn't it? Yeah. Siyasema tunapigia kura, lakini anajaribu. Na watu wangapi wanaweza kwenda ku risk life yao hivyo? Very few people. So Gachagua provincial officer, remember. Hii usiandike hii provincial officer generally, Gachagua was a district officer who grew in ranks, isn't it? Yeah. Akafika mahali deputy president akafukuzwa. And then now we have Kenya without what here? Government. Kenya without government. Kenya minus government. If you make KE the subject, they will make KE the subject in MBA. Make KE the subject. If you make KE the subject. So I shall cross multiply, it will be PO into KE minus G equals DO into 1 plus G. Is that okay? Yeah. Can we divide both sides by PO? Yes, by PO like that. So this and this. So to be left with KE, don't write this. Idiot to address it our letter shida. Saki moment derived formulas. So to be left with KE alone, we take G to the answer. So KE then will be equal to DO into 1 plus G PO plus what here? These are minus. The other side becomes plus G. Like that. This is where they're getting those formulas. All right. But for us, ladies and gentlemen, please don't ever try to, whenever they talk of cost of equity, you can even write it this way: cost of equity retained earnings. Always remember it's dividends model. I connect this formula to Gachagua because Gachagua is the one who was saying mambo dividends, isn't it? Dividend valuation model, isn't it? Dividends. So kisikia cost of retained earnings, hiyo tu nilimharibia kidogo, otherwise that guy would be a very, very good leader. Hiyo tu kidogo. PO into 1 plus G over what here, somebody? PO, cost of retained earnings. Don't forget, because I've marked this AFM for so long, you'll get a very bright student getting cost of retained earnings just by leaving it like that. No, there must be what here, somebody, another G like that. Can I ask you a question? Why don't we have flotation cost here minus F? Retained is already with us. It's an internal source of fund. You're not going to raise anything outside there. Remember, raising funds, I can't get rising. Hata Kenya ikienda to raise funds huko America, wapi na Eurobonds. They even have trucks on the road. People are dancing. And they're dancing there. What is happening? There is cost to it, isn't it? So shares, you must always subtract flotation. Bonds, the same. You can't float bonds for free. You must have that flotation. All right. Now, where I've reached, having given you this formula, I want you to give me the cost of equity retained. KR ama KER, doesn't matter. KR ama KER. Sasa, this examiner was a little bit bad, sadist of examiners. You see, this G is the growth rate of dividends. Yes. Kuna question, eh? Okay. The formula. What I would want them to do, I don't want them to, I know she wants me to show them how to do all this. No. Please, just master the formula here. Cost of retained earnings equals what here? PO into 1 plus G over PO plus what here, somebody? G. You can never go wrong. That deriving will really mess you. Yes. Thank you so much. So in this case here, growth rate of dividends. We are used to be given a growth rate. But in this semester, he never gave us the growth rate. He gave us various dividends. Are you able to see like 5 of them? 1, 2, 3, 4, 5. Yeah. So from those dividends, please give me the growth rate. From those dividends, give me the growth rate. I'll give you 1 minute because I know you are experts. I know you are experts. They're not writing anything and they know. They're not writing anything and they know. I know they know. That one I know. So the compounding formula, use compounding formula. There are 2 formulas here. Use compounding formula, where basically you'll be able to tell us that growth rate equals the most current dividends, DN, all over the very old dividends, right? Raised to 1 over n minus 1. Like that. Kwanza andika namna hiyo ni kuonyesha maneno. Andika namna hiyo ni kuonyesha maneno. DN is the latest dividends. PO, earliest or oldest dividend. And then we have n in this case here is a number of years of growth. Number of years of growth. So now I would want us to really write down these dividends. Let's write them down, these dividends. So the dividends we have, and they have put a column for EPS there to confuse you. Remember, G, we are using dividends column. G, we are using dividends column. So the DPS that you're able to see there, we have 3.0, 3.1, 3.3, 3.5, 3.2. So which one is the very oldest here, somebody? 3. This is the oldest. And this is the most recent, isn't it? Most recent. So the oldest is what we call D0. The most recent is what we call what here, somebody, the end. How about number of years of growth? Number of years of growth, how many are they? Are they 5 years or 4 years? Remember, this is the beginning year. So we have year 1 growing. I can see another growth there, and another growth there. Isn't it? So number of years of growth are how many? 4. You simply take the number of years you have here minus 1. Minus 1. So number of years of growth are 4. They are 4. So Mwalimu, what are you saying here? We are saying here that DO, you are the ones who have told me that DO in this case here, the very old dividend is 3 points, or simply 3. And then you've told me the N is what here, somebody? 3 points. And then our N equals what here, somebody? 4. So come and give us the growth formula. So growth formula, there are many. dN over dO into 1 over what here, somebody? N. Minus what here at the end of the day? Minus 1. G will be equal to dN, which is 3.6. Over what here, somebody? 3.0. Yeah, raised to. So raised to, this has to be into brackets, 1 over what here, somebody? 4. Raised to 1 over 4. And then whatever answer I get, I say what there? Minus 1. So ensure that this 1 over 4 is in the brackets as you raise. Are you able to see in your calculator raised to? Malimandikwa. Most of them are not giving me an answer. All these numbers must be in brackets, except 1. All the other numbers must be in brackets. All the other numbers must be in brackets. They're getting 0.4, 0.4, 0.0. 6 like that. Online, is there any student who is getting that figure really? Oh, okay. Then in terms of percentage, this will be 4 point what here, somebody? 6%. That is the growth rate. The other option, method 2, you can simply say G equals the nth root. Yeah, nth root. Yeah. So nth root. So we have here dN over what here, somebody? dO. Whatever answer you get, you say minus what here, somebody? Minus 1. But then here you have to be very, very careful. You see, this is dO. This is dO here. This is D1, D2, D3. And then we have D what here, somebody? D4. So meaning that our N will be 4. N will be 4. So nth root. So we have here N is 4. dN, the fourth dividend here, dN, 3.6. Divided by what here, somebody? 3. Whatever answer we get there, we say minus what here, somebody? Minus 1. Method 2, nth root. Nth root. So then you have to be very, very careful. Please pick up your calculator and see whether you can see x root. See whether you can see x root, not square root, x root, x root. So then you start by pressing 4, and then you say shift for you to get that x root coming up. And once that x root comes up, be a man who loves brackets. Say brackets, 3.6 divided by 3. And then you say equals. Because you see this is independent. And then whatever answer you get, you say minus what here? Minus 1. Don't use square root, but use what here, somebody? X root. X root. In a way, the same. Which method do you want us to stick with? This second one, eh? This second one I'm told is better. The second one I'm told is better. The second one I'm told is better. The second one is better. Second one is better. So all of us, I hope you are seeing the messages there. I hope you are seeing the messages there. All of us up to here, are we really together? Let me just drop this. Great. We are okay. Thank you so much. We are okay. But now listen and listen to me very well. Listen and listen to me very well. At times, the examiner would want you to use, so this is a note. This is a note. Now, ladies and gentlemen, remember in life, how do we grow? We grow through savings and investing these savings wisely to earn a great rate of return. We have another method of getting this growth rate, what we call BR. BR. Yeah, this is just a note, not for this question. Yeah, where B is the retention ratio, and then R is the return on equity. Return on equity. Rule like that. Return on equity. These are very, very important formula. Why is it important? Because automatically it works with our day-to-day living. Where B, we are looking at, out of my salary, how much am I able to save? Perhaps I'm able to save what, 60%. When I save these monies in banks and they're not giving me any interest, no return, useless. I can't grow. So growth is a function of, how much are you retaining? And whatever you're retaining, which kind of investment vehicles are you putting this money in to get some return? Some return. Very, very important. Retention ratio times the return I get. So you will see most of your questions in your past papers will be using this formula. G equals BR. Very, very important. I'm not going to use this formula today. No. So in all of us, we've been able to get our G, if we continue, as 4.66 like that percent. Now remember, what are we doing, Mwalimu? What Mwalimu is doing is to get cost of equity retained earnings, whose formula I must keep on reminding myself. It is the Gachagwa's dividends. DO into 1 plus what here, somebody? D all over PO plus what here, somebody? G. So I want to give you 1 minute to see how you're going to sub. Now we have everything. We have G, we have PO, we have everything. Now we have everything. So for this DO here, shall I use like the 3 or the 3.6? Yeah. When you look at the table, don't be confused by the growth formula. When you look at the table, DO stands for the most recent dividend. The most recent dividend is 3.6 into 1 plus 0.0466. Is there somebody who is able to see the current market price of a share? PO is the current market price of a share. 50 from note number. Note number 2, we are told that a share currently is selling for how much here, somebody? For 50 shillings. An ordinary share is selling for 50 shillings plus growth rate, which is 0.0466 like that. .109. I haven't seen anybody from online confirming this answer. I haven't seen anybody from online. So I will pick it with some pinch of salt until I get confirmations. Online guys, what are you able to get for your return? They're getting 12.22. You get 12.22. Kwa umepanchaje calculator? Umepanchaje calculator? 0 point. Hebu tuende pole pole. 12.19. 12.2. That is the same. We can't fight over that decimal. 12.24. People are getting now different, very different answers. Let's not put rounding off error. Tukitumia here, there, 1 more. Twende pole pole. Please, let's use this figure the way it is here. So we say 3.6 times, open brackets, 1 plus 0.0466, close brackets. Then you say divide by 50. You say equals fast. Because you see this number here is independent, isn't it? Yeah. Whatever you get, you add again 0.0466. Let's confirm who is telling us the truth. Hii iko offside sana hii. Stanley. Then you balance. So wanasema itakuwa 0.122, which is the same as 12.2%. Is that the number that also the online guys are getting? 12.22 like that. So then we are doing a very, very good job. So then let's go forward and get cost of equity by the ordinary shares. Cost of equity, ordinary shares. I can either write cost of equity dash ordinary shares. Ordinary shares. I can either write it as KS or KES. KES. Which will be DO into what here, somebody? 1 plus G all over. Yeah, this one, there is a floating, isn't it? Flotation cost. At the end of the day, I will never forget what they are. I will never forget G. 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 All right. So, of course, we know that this PO minus F stands for what we call net proceed. Net profit. If there was any discount also, because you can give discounts on shares, you will subtract. So is there anybody who is able to give me the flotation cost from note number 2 of these shares? 10% of 50, isn't it? 10% of 50, which gives me 5. So every share that I issue out there will give me a net amount of how much? 45. Because the CPO is 50. But you see, I'm going to declare 5 shillings to float. So every share is giving me 45 shillings. Net proceeds. I'm trying to bring to your attention about some terminology that your examiner can use. They'll tell you the net proceeds of a share is 45. So KES will be equal to PO, which is what here, somebody? The 3.6, the current dividend, isn't it? Into 1 plus 0.0466. All over the net proceeds, which are what here, somebody? 45. Whatever answer I will get, I will come and say plus 0.0466. Whatever answer I get here. So, and what are we able to get here, Bwana Stanley? 0.1303. They have to be a bit expensive, isn't it? 13.03%. Is that what the online guys are getting as well? Is that what the online guys are getting as well? 13 point something? Yes. Thank you so much. Thank you so much. Thank you so much. Thank you so much. We've been seated down here doing this class all the way from 8 in the morning, lower classes. And then we started with AFR at 10. I feel tired now. I feel if we stop there, we are okay. We shall overcome. So don't miss tomorrow's session because of what here? Because of the, of course, finishing this question and tackling what we call yield to maturity. Very, very important. It has been a pleasure hosting you. Bye-bye. 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 Bye. All right. Thank you so much. See you again tomorrow. I scroll up, okay? I don't know up to which level. Maybe here. Alternatively, you can ask your fellow students to send you all the notes. All right. Okay.